Hi, Steve. I think we're ready to start.
Okay, Hannah. So I'm just going to check that our three presenters can hear me. So Darren.
I can.
Yes, I'm here in Cambridge.
Morning, Darren. Harren, I don't know where you are, but I've heard you.
Yes, I'm still here.
And Neil, are you on as well?
I am, yep.
So Hannah, I'm about to start, so if you want to press record so that we are ready to go.
Yes, all ready.
So good morning everybody and welcome to this BIA webinar on raising capital in the current environment whilst retaining control. I think this is a really interesting and insightful topic for anybody who is looking to develop their company, and I'm delighted that we're able to hear from three key CEOs who've been there and done it recently. I think the thing that I've learned in my time in this job is that there is no way that companies are built from a textbook at a business school, and the best way to find out how things are actually done is to talk to the people who've been there and get the benefit of their experience and hear their top tips. So the format for this morning is we'll hear from each of the presenters. Hannah, if you can move the slides on, please. To see, we've got Darren Disley, Harren Jyoti, and Neal Murray, chief executives of some of the most exciting companies in the UK life sciences firmament. Each have their own story to tell, and each have come a different route to this. But perhaps I can, just before we go to each of them for 10 minutes, or up to 10 minutes on their experience, and then time for questions after, I can set the scene by talking a little bit about the financing environment as we go into the second half of 2016. Next slide, please, Hannah. You're probably aware that the BIA has published its Money, Momentum and Maturity UK Biotech Financing and Deals in 2015-16 report recently. It's available on the website. A couple of points on this. If you look at the background for where we're at as we go into the second half of 2016, we've had another great year in 2015 with venture capital activity in the UK at a record high, and AIM-listed biotechs raising an additional significant amount in capital during the last year. Interestingly, we're seeing mergers and acquisitions, not just from the big players of the smaller players, but also within emerging companies. And the UK remains an R&D powerhouse for the world, with over 585 pipeline projects in development, the largest in Europe. If I just drill into two or three of these points, next slide. If you look at venture capital activity, the bars in this chart on the left-hand side show the comparison with previous years. So you can see in the last 2 years, there's been a significant amount of venture money going into the UK life science sector. Interestingly, I think what we're seeing is fewer but larger rounds, and that may mean that that we're seeing the support from venture capital to enable companies to have enough money to succeed rather than just enough money to make a mistake and fail. And this trend, although it may mean it's more difficult for certain types of companies to get financing, may mean that we're actually building stronger companies. Next slide. I think this is an interesting slide. It's a bit small, but do look at it in the report if you're interested in the detail. The interesting thing here is if you look at the 10-year horizon, you can see that there's lots more money in the last 2 years for the London Stock Exchange than there has been for really the previous 8. And interestingly, it's the second bottom two bars in the right-hand side, the purple and the lighter purple, which shows in FO the follow-on amount of money that's been raised by people who are already on the market. This is a new trend and something that we haven't seen really very much prior to 2012. And I think that bodes well and shows that there is a new climate for financing, with investors prepared to follow money in the stock exchange. Next slide. And finally, if you just look at the detail of the pipeline, you can see the UK is well ahead of its European neighbours in terms of pipeline, and is a really strong powerhouse for R&D. Globally, but particularly the leader in Europe. So I hope that's useful background. What's next for 2016? Next slide. A couple of thoughts. I think because of the uncertainty in the macroeconomic and global political dynamics, there's no room for complacency where we've got to. There's a flag from me that the seed capital in 2015 has gone down, and maybe we need to make sure that that's looked at to ensure that there is effective early stage company financing, and we all need to work together, government, industry and investors, to support our momentum, not only in starting up but in scaling up businesses going forward, whatever the rest of the year holds. So if I may, with that as an introduction, I'm going to hand over to Darren Disley, the Chief Executive Officer and President of Horizon Discovery, one of the most vibrant and interesting people in our sector, who's going to tell us a little bit about how Horizon have worked to raise capital whilst retaining control. Darren, over to you.
Thanks very much, Steve. Good morning, everyone. I've only got a couple of slides, but I thought I'd just sort of set the scene a bit. The story I'll tell you today was how Horizon Discovery was able to bring capital in of different types at different stages of its business that supported the development of the business to meet the strategy and the objectives of the early founders and investors. But the strategy here was really born over quite a period of time for me, having brought in the wrong types of investment capital for businesses over the preceding 10 years prior to that. I'd learned a lot of experience from the mistakes that I'd made and came into Horizon with a very clear vision of what we needed to do, which was to bring the right type of capital in that aligned with the interests of the founders and how they wanted to evolve the business. So hopefully you'll find the Horizon story interesting from that perspective. If we go to the next slide. So Horizon, just at the top level, we are trying to position ourselves in the marketplace as the cell builders. As Illumina is to DNA, Abcam is to proteins, Horizon aims in the next 5 years to become known as the definitive cell builders, where everything about how you design, engineer, and apply gene-edited cells to advance human health care. So what do we actually do and why do we do it? As human genome sequencing efforts start to identify the minute genetic drivers that are responsible for diseases of aging, particularly like cancer and Alzheimer's, if you're in a position to do something about that, to moderate that genetic driver back to a normal healthy state or even correct it, you're in a fundamental position to have a major impact on human health moving forward, improved therapies for patients, a much better deployment of increasingly scarce healthcare resources, and delivering a new model for drug development that delivers increased returns in shorter periods of time. So essentially what Horizon does is deploy a very powerful and flexible gene editing platform, and we design models. These are effectively recapitulating the genetic drivers that mean that a patient like Noah and in his both diseased and healthy state can be represented in a laboratory test system. These drive the understanding of the genetic drivers of disease, and then because you're in a position to now use that same gene editing technology to correct those diseases, you're able to start developing novel molecular cell and gene therapies. So giving you a bit about our business fundamentals. So when we came into being as a virtual company in the second half of 2007, the cost of sequencing a genome was still in excess of $10 million. So there wasn't exactly lots of people out in research sequencing genomes and trying to identify the genetic predictors or drivers of disease. So this was not the occasion to be out raising a very serious venture capital round for a market that really was very nascent still at this stage. So we took a seed funding in March. Hello?
Keep going, Darren.
Okay, we took seed funding in March in 2008, around £150,000. This was from angel investors. And pre our IPO in March 2014, we'd had 20 million of pre-IPO funding. We very much took a lot of angel funding early on. It was almost exclusively angel funding on an ordinary share basis, very simple sort of share structure. We then brought in 2 million of corporate investment from Genentech and Roche, very much our customers who helped us develop the platform and helped us market the platform effectively to the other pharmaceutical companies. And then much later, within the last 2.5 years before the IPO, we took 6 million of funding from venture capital. Because we raised money at times when we didn't need to raise money, so I'm a big fan of actually trying to get ahead of the game, delivering revenues, delivering your plan against expectations. That put us in a position to raise money when we didn't need it. So at each stage of our funding journey, we were able to return money to the early investors, whether it be the University of Cambridge or the founders. So 7 million was returned pre-IPO. And the benefit of that was really about a realignment of interests of those early shareholders. Often what happens is people are looking for exits at particular points in time. So this meant that we were able to keep the university happy, keep the founders very happy in buying their houses and various things like this. So when they came to work, they were focused on how we build a business. We then went into our IPO in March 2014. So we raised 68.6 million. That 68.6 was 2.8 oversubscribed from around 61 institutional investors, and we returned 28.6 million of that to the pre-IPO investors. At this stage, post the 7 million pre-IPO, the founders had been diluted 3-in-1. So we're still in a position of controlling around 40 million of the 120 million pound market cap. We then, as Steve said earlier, went on to do a follow-on raising in May. It was actually 2015. Apologies for that error. In May 2015. And the business now is investing that capital and driving its growth significantly. You see 120% in our products business, 70% in our services business, and targeting break-even next year. On the final slide, before I hand over, was just the reason why our funding strategy evolved like this. If you look at our business, our funding of our growth was very much aligned to this transformation of the understanding of genetic basis of disease. So in late 2007, when it was $10 million to sequence a genome, there wasn't much market to sell genetically defined cell lines. So what we did was run an organic business early on. We did $500,000 of revenue in the first 9 months, then $2 million in the next 12 months as a niche products business. We then built out our service business around that, and as the cost of DNA sequencing came down, it's now driving a concomitant demand in the need for gene editing products and services. So we transitioned through a service business, which then got us to IPO, and then with the IPO funds, we've built out that platform, and our business is now refocusing back to where it started as a product business because there's now such great demand. So moving forward, the business will be a products-oriented business. So I hope this gives you an idea of how we aligned our funding with the growth and market opportunity of our business and delivered a business that delivered returns for shareholders at all stages, but in proportion to the risks and stage that they came into the business. And that's it, Steve.
Darren, thank you ever so much. Perfect and on time. I'm going to encourage people to put questions in on the chat system as we can see it, so that we've got them at the end of the 3 presentations, and hand straight over to Dr. Haran Jyoti, the Chief Executive Officer and President of Aztec Therapeutics. Haran.
Thank you, Steve. Thank you, and hello to everyone. So what I'm going to do is tell you a bit about the Aztec story. In a way, we're quite different from Horizons, from what Darren just described, in the sense that we weren't focused on a kind of service model, very much focused on trying to develop small molecule therapeutics. So in terms of a summary of the company, so we're focused on small molecule drug discovery, primarily for oncology. We use a fragment-based drug discovery platform, which is, as I'm sure many of you know, a method of developing small molecule drugs, quite different to high-throughput screening, and Aztec was one of the pioneers of this methodology. We have a range of compounds in late-stage development, which we're continuing to move forward. We also have a range of partnerships with Big Pharma and also academia. So while, as I mentioned, we weren't focused on as a service model, we were very keen to try to raise capital, raise funding by doing licensing deals along the way as the company developed. And I'll touch on that in a moment or two. We have operations here in the UK, based in Cambridge here, our research headquarters, and in the US on the East Bay in California, in San Francisco. And we're a wholly owned subsidiary of Otsuka Pharmaceuticals. And so that's a transaction which I'll also talk a little bit about. So in terms of a history of the company, we started back in 1999. I founded the company with Chris Abel and Tom Blundell. And we raised quite a bit of venture capital. In fact, in 2001, when we did our Series A funding, it was probably one of the largest fundraising for a European life sciences company at the time. We raised approximately, I think it was around 23 million pounds in total in the first round financing. Then, as you can see from this biotech lifeline chart, which I've shown on this slide, you can see how perilously close we got to running out of cash, particularly around January 2007. But also you can see the injections of cash either from the subsequent funding rounds, Series B and Series C, but also the pharma collaborations that we did along the way. And so the kind of general concept or the general topic of trying to access cash or access finance while trying to retain control, it manifests itself in many different ways. For example, when you're doing a licensing deal, you get access to significant funding, but you do relinquish control to some degree. So on the next slide, I've given you an indication of some of those programs in which we licensed out to different pharma partners. And these are all programs which are under the control of these different companies. So there's always that balance as to could we have developed them faster ourselves compared with the amount of access to capital we obviously got from when we did the licensing. In many of these cases, we got significant upfront monies as well as the ongoing milestones, and then eventually we'll hopefully get royalties. The most developed or most advanced product is ribociclib, which is a CDK4/6 inhibitor with Novartis, and they are planning to file for approval this year based on some very excellent phase 3 data. And the other one I just single out here is the beta secretase compound, which AstraZeneca are now, together with Lilly, developing for Alzheimer's, and that's in a phase 2/3 trial as well. So one has to make these judgments as you go along when you build a company. In the first instance, obviously, taking in venture capital, you clearly give up control to a significant degree to the VCs, but of course you have to make sure, and if they're good VCs, they make sure that the objectives are aligned between management and investors. So the next topic I just want to touch on is the merger we did with a company called Supergen back in 2011. So at the time, around 2007, 2008, we were looking to see whether we can do an IPO on the London market, but as you probably all remember, the financial crisis was around that period, and that put a stop to any such plans. So we were approached by this company on the West Coast, NASDAQ listed, so obviously a public company, but also, as importantly, they had significant cash in terms of future royalty streams from a product which was being marketed, and also a significant balance sheet. So in effect, this was a financing event for Aztec. That's the way I positioned it to the board, and a company building exercise. So we were able eventually to do the merger. We had a few problems first time around with a couple of VCs, which I may or may not comment on. But we were successful to do this merger, which then resulted in Aztec Pharmaceuticals, which was then a public NASDAQ-listed company, and therefore that's why we have two sites, one here in the UK and the former Supergen site, which is now an Aztec site. Then in 2013, we were acquired by Otsuka for nearly $900 million, which was actually the 7th largest deal in that year, M&A deal. Otsuka are the 2nd largest pharmaceutical company in Japan, with a focus in CNS oncology primarily. And then just to finish, some comments on some of the experiences that we've had through these transactions. I think when you do a merger, these are very tricky things to do, particularly cross-border merger. So the issue of that, we're trying to retain control. Obviously, the board composition is a key area which one needs to think about. In our case, renaming the new company as Aztec allowed us to retain the brand and influence. And then the acquisition by Otsuka, and as we all know, one of the biggest issues for small companies, small biotechs, when being acquired by a large pharmaceutical company is that we just simply get swamped or integrated into the larger organization. What we were able to do in this case was during the process, which was being run by Jefferies, we were able to secure assurances from Otsuka that we would continue to have our name, survive the transaction, so continue to call ourselves Aztecs, and a pretty significant level of operational independence. And at the end of the day, what they're really buying, of course, is assets in terms of drugs and technology, but people are the most important assets, and they know really to try to ensure that they can maximize their investment. They want to keep the people. So once we were able to articulate these assurances that we received from Otsuka to the team, that we actually resulted in very few people leaving. So that's been a very positive outcome. And so, as I said right at the start, we are a wholly owned subsidiary and continue to run as effectively a small biotech within the Otsuka organization. So with that, I will hand it back to Steve.
Aaron, thank you very much indeed. And without further ado, I'm going to pass it straight on to Neal Murray of RedX. Neal.
Good morning, everyone. Thanks, Steve. I've only got a couple of slides, a bit like we, for those of you who don't know RedX, we're a similar kind of organization, I guess, to Aztecs, in that we're a small molecule discovery and development organization. We're focused in cancer, immunology, and infectious disease, based in the Northwest. And a little bit like Aztecs, we've taken the approach of having a broad-based pipeline in order to mitigate the risk that you normally see in drug discovery and development. Clearly, that has consequences on the funding side of the business because you're going to require more cash. And we've taken a slightly different approach to either Horizon or Aztecs in the way that we've funded the business up until now. If we move on to the next slide. I put here a history timeline for the business over the last 6 years or so since the company was founded, and highlighted the fundraising activities that we've had at that point. We've been quite unusual in the sense that up until the IPO of the business in March of last year, pretty much all of the capital that we raised was from high net worth investors. That has challenges. There are no questions about that, but equally, there are an awful lot of benefits of having high net worth investors on your register. They tend to be fairly stable investors, mainly because they're investing on the back of EIS benefits, so they're looking at a minimum 3-year timeline for their investment. They tend to be supportive of the business once they're in, so it is likely that they're going to come back and provide further funding to the business. But equally, on the other side of it, whilst we had individuals, and indeed still do, like John Moulton, who are ultra-high net worths, we also had a number of smaller investors. And so you need to make sure that you're providing the right level of feedback to those investors to make sure that they're comfortable with the progress of your business. We also made a lot of use, as you'll see in the timeline, of non-dilutive capital. We were lucky enough to secure 3 regional growth fund grants to support the different areas of our business. And up until the IPO, we actually brought in around about 50% of the funding to the business in a non-dilutive fashion. And clearly, from a point of view of retaining control, that's a very important aspect to how you fund your business. RGF funding is very straightforward funding. It is around creation of jobs, and there are very few strings attached to that funding, and comes in at very high intervention rates, so between 60 and 70% intervention rates for the business. So up until the IPO, we raised around about 25 million of capital and non-dilutive funding. We floated the business in March of last year, as I said. And the reason that we went down that line, rather than pursuing VC investment, was because of the breadth that we had with our high net worth shareholder base. If we'd brought in VC investors, then those shareholders, those original shareholders, would have had a problem with the EIS qualifying status for their investment. So they would have lost that if we issued anything other than ordinary shares. And so we took the decision that rather than going down the line of bringing in VC investment, that we would look to the public markets. In addition to that, we were looking to access those capital markets with a view to funding the business going forwards in a much larger way than we had done historically. And so we floated the business in March of last year. We did a follow-on round in April of this year, and between the two of those, we brought in about 25 million. And the business is now very well positioned to build on the broad pipeline that we have. We'll be in clinic early next year with our lead programs, and we're looking to further build that pipeline out through a combination of organic and inorganic growth in the business. The next slide I have is just to try and talk about some of the ways that we've sought to retain control in our business. Control doesn't always equate to shareholding, is one thing that I would say. You can have an awful lot of control and influence over your business without having to have 40 or 50% shareholding in the business. And a lot of that comes down to how you do things like build your board and build your investor base and the view that those investors are going to have of the business. I've already talked about non-dilutive funding. As part of this thing, there's a lot of credibility attached to the story that you put together to underpin the valuation of the business as you go through. If you continue to build that value, then, particularly if you're dealing with high net worth investors, and it's worth noting that a lot of those investors are actually sector naive, but with those high net worth investors, then as they can see the valuation growth in the business, they are much more inclined to maintain their participation in the company. So critically, you've got to make sure that you're continuing to see development in that story as you go through. I can't stress enough the third point on this slide in terms of being opportunistic. We've done a number of things as a company as we've gone through that a lot of other companies wouldn't have looked at doing. And that's because we've identified opportunities early, and a perfect example of that is the collaboration that we did with the NHS in 2014 around our MRSA asset. So we had a program that, in order to get a commercial deal for, we would have had to take through to clinical proof of concept. And we looked at that, and we weren't, given that it was MRSA, we weren't particularly inclined to invest our capital at that stage in a gram-positive program. We were much more interested in gram-negatives. And through a conversation with the chief exec of a trust in the NHS, who indicated they were looking for programs and particularly indicated their continuing concerns around MRSA, we ended up getting into a situation where we did a collaboration deal with the NHS around our MRSA program, which brought in just under 6 million of funding to us in return for giving up a share of the future commercial rights around that program. That deal was very unusual. We've been told by the NHS it's the only time that they've done it. But importantly, it took 18 months to do that deal. It only got approved 6 times at the trust board as they went through that process. And a lot of people would have walked away from that deal. But we looked at it from the perspective of it was an asset that we otherwise probably would have deprioritized given everything else that we had going on in our pipeline. And it was a way of funding that asset through to a value inflection point. So those kind of things you've got to be able to identify early on and be opportunistic around doing unusual deals. You've also got to be prepared to say no. We had, particularly in the period running up to the IPO, we had a number of approaches from VCs interested in investing in the business. But back to this point about control, we were going to have to, as a management team and indeed as a board, we were going to have to give up significant control in the business at that point in order to bring that investment in. And so you've got to be prepared to look at where you want to see the business going and make sure you're bringing in the most appropriate sources of capital that are going to allow you to develop that business. Understanding your investor base, I think, is key, particularly when you're dealing with high net worths, as I say. We spent a lot of time working with those high net worth investors, making sure that they viewed us as one of them described last week, a proper company. A lot of high net worths that are investing not just in biotech but across the piece will get presented with all sorts of investment opportunities. And the more you can make it look to them like a proper company, the more likely they are to trust you with their cash. So it's very much about giving to Caesar what is Caesar's and spending time with investors and educating them and helping them through that process. And one of the consequences of that for us has been, when we came to the public markets, given that the public markets in the UK are dominated by generalist investors, it was very much just a natural extension of the work that we've been doing with our high net worth investors in the years up until that point. And so, making sure that we have the messages pitched in the right way, in an understandable way, that are not blinding people with science, is a key part of getting that story across. And that's something that, as I say, stood us in very good stead. Credibility, I've already mentioned, particularly around the board. One of the things that we found as we went through was, I think if we were being critical and looking back now, our board wasn't quite as good as it could have been. I think we've certainly fixed that now. We've got a very strong and credible board and have done for a couple of years now. But again, it's this thing about getting investors to part with money and trust you to manage and control the business without them trying to exert overdue influence. And finally, nothing succeeds like delivery. It's absolutely key that whatever you tell people, then you deliver on that. Because again, it's to this thing about them trusting you to run the business. It's the only way to do it. Over to you, Steve.
Neal, thank you very much. So it's time now for questions from the floor. I don't have anybody who's given me one on chat. I hope the technology hasn't defeated you. But Hannah, perhaps we can open it up. And if there's anybody who wants to venture a question from through speaking, either on the phone or on the computer, now is your time. Questions. If I may, if there's no question from the floor, Darren, I was going to ask you, Neal's talked a little bit about his experience of high net worth individuals. You talked about the importance of angels to you. Is there a challenge with mixing different types of investors, and how did you keep your early investors happy? I mean, was it like Neal, is it an EIS play, and are they happy as long as it's in for 3 years, or was there more to it in terms of how you managed them?
Yeah, I think my view is that I take a little more holistic view to this. I don't believe there's any such thing as a good or bad investor. I just think that there's either an aligned or misaligned investor. And I think depending on the type of business you have and the business model you adopt should determine the type of investor that you bring in. So when you bring angel investors in, and I've done that to a lot of businesses, whether it be tools businesses or therapeutic businesses, if they're aligned with where the management wants to take the business, and that they feel the management has the right strategy, the right governance in place, the right communications with them as high net worth individual investors, I think they'll be incredibly supportive. I think, with really good investors, and I'll use like Herman Hauser, Jonathan Milner, David Cleveley, these guys who have been around the block a lot, if they're managed well and they're aligned with what the founders are trying to do, they'll be very supportive. I don't believe the 30% EIS relief is a calming influence for them where they're sort of waiting for 3 years. Because I've had experience where there's been problems with EIS investment and they, etc. The key is to manage that well, but I don't think it's the driving factor or whether they're aligned or misaligned with what you're trying to do. So my experience with high net worth individuals has been very, very positive in life sciences. I've had some negative experience actually in the tech sector, where you've got very wealthy high net worth individuals who've invested in the company and behind a vision, but then found that they wanted to change the direction the company went into. And the problem with that is that if you've got a super wealthy person around the table who is now fundamentally opposed to your strategy, that can be more problematic than having a venture capital investor who is ultimately accountable to their venture partners, whereas a high net worth individual with $1 billion in the bank is accountable really to no one. So it's not a panacea having high net worths. You still have to align them with your strategy, and you have to communicate. And my thing is communication. They tend to get really frustrated if the company takes their money and the next time they hear from them is when they need more money. It's about effective communication.
Thank you.
If I could just add to that, I completely agree with what Darren's saying there, and particularly this point about communication. It's also one of the challenges for a business that if you've got a significant group of high net worth investors still on your shareholder register when you go public, actually being able to maintain that communication in a meaningful way as a public company with all, it was challenging enough before, but with the new market abuse regulations coming in, it's even more challenging. So, communication with these guys is absolutely critical, and you've got to spend a lot of time making sure that they're comfortable with the model and where you're going.
Neal, how have you found having a large number of high net worths on the share register following your IPO? Have they held on to their shares, or have they been leaking them out?
No, they've held on. I mean, there was a significant lock-in at the IPO. That lock-in came off in March this year, and they're pretty much all holders. We've had a couple of people that have cashed in the shares, but more or less they're all holders. And the message that we get back from them is they're still in it for the long term. They see, the potential upside in the business as we go forwards, and so they're quite happy to hold. And indeed, some of them have been mopping up shares in the market.
Thank you. Aaron, you alluded to experiences with VCs. Are there things that you would do differently or advise people if they were approaching VCs for the first time to make sure that they test it out?
Yeah, I mean, there's a lot of questions around, how do you select the right VC? I mean, because when we set up, we had a couple of different offers, and probably the most important decision that certainly I think I made, or we as a management team, was to choose our lead investor, and because our lead investor was Abingworth, and what they were able to do is very quickly help us build a board and a group of advisors, which really gave us credibility. And coming back to, I think Neal was making this point, really credibility is a real key thing that you have to try to establish very quickly. And one way to go forward is to have a high-profile investor like Abingworth, who will have a good network of consultants and good network to find non-exec board directors to be able to get you off on the right foot there. I mean, one of the problems with VCs, or one of the many problems, is that when you get misalignment between the different, if you like, the different syndicates which come on as you grow the company, and that's a kind of tricky thing to manage. So what you really have to resort to is having confidence in your lead investor to iron out issues, problems as you face them, or as a company faces them. When you get some kind of misalignment, you're always going to get some kind of tension between VCs, because we all know what they're like. But broadly, our experience was very positive working with VCs, and I think it's probably because we were lucky enough to have some of the better ones. So Oxford Bioscience was another key VC for us, GIMV. So we had 6 or 7 top-tier venture capitalists from the US and Europe.
Wonderful, thank you. I'm going to ask a final question before we close, and that's around timing. I mean, I think, you know, we see that markets and the sector goes in cycles. Do you think there's anything that particularly people should think about if they're thinking at this particular time, or whether you think it's similar to stages where you've looked for capital, or whether there's anything particular that people need to think about in 2016? Perhaps Darren, to you first.
Yeah, I mean, I'm a great believer. I give a talk around it. I actually think difficult times are the best times for entrepreneurs to start businesses. Now, clearly, the sorts of businesses I typically run are not therapeutic businesses, although I am part of therapeutic businesses that have raised lots of angel funding, etc. But I think downturns and times of scarce resources are actually good times for entrepreneurs. But you often have to just maybe adjust your business model, your early expectations to deliver against a plan early, and then you create scarcity value for future investors around this. So I think what investors are looking for right now are people who have business plans that they believe that they can achieve, that with management teams that are going to be pragmatic. They're not going to, you know, try and solve the world's problems in the worst recessionary periods, for example. So I think pragmatic management teams with business plans that can be achieved, and getting the right type of investment in for that stage of the business, I think, is key right now. It's not the time for vanity raises.
Thank you. Aaron or Neal?
Yeah, I mean, what I would just say is I think good ideas are people always invest in good ideas despite what the economic environment looks like. I actually think there's quite a lot of money out there. I mean, people don't know where to put money at the moment to get a return. So, you know, I think anybody has a good idea, solid business plan, should just absolutely go for it.
I'd agree with that. I think, you know, there is a lot of money out there, both on the private side in terms of high net worths, and also in terms of the public markets as well. I think at the moment, unfortunately, there's a little bit of a cloud hanging over the sector in terms of the public markets, but you know, I see that as very much a kind of temporary thing, and certainly based on the discussions that we have with institutions, I don't see that as something that is going to hold good companies back, let me put it that way. On the early stage side, it's going to be interesting to see just how much VC money continues to filter through to early stage businesses. I think companies are a lot more pragmatic now around accessing early stage capital. I think that's one of the consequences of the last sort of 6 or 7 years, you know, where we went through a period where early stage capital from VCs just simply wasn't available. I think that people have started to find alternative routes to get that early stage capital, and that's something that is only to be encouraged going forward.
Thank you. One final question has popped in on the chat, and I will ask it before we close. Do angels correctly value biotech companies, or are they more focused on the EIS release? And if an R&D company finds itself with angels, are they simply postponing the day when they take the VC money and then accept that pain? I don't know if people have views on that.
I don't think so. There's 2 questions there. Do they correctly value biotech companies? No more or less than any other investor. Is the way that I would put that one. And a lot of it comes down to educating your investor base and making sure that they understand where the value accretion is going to come from. If they're sector naive, then chances are they're not going to value it correctly. But that's where you've got to sit down and work with them and explain and have a very strong business plan that is going to demonstrate where that value is coming from. Are you just putting off the day? Well, I would argue that our example shows that you're not just putting off the day, that there is an alternative to taking VC funding. Darren went through both angel and VC before he got to the public markets. So, there are different ways of doing it. And I don't think, to this point that Darren was making about aligned and misaligned investors, it's about what's the right investment for you as a business at whichever stage of growth you're at, rather than saying, oh, we've got to just have angel money, we don't want VC money, or we're just going for VC money, whatever it might be. So, it's very much horses for courses.
Just one point. I think, I agree with completely what Neal has said there. One thing I have seen, as I'm a prolific angel investor in early stage companies, and I mean very early stage companies, is there's certainly, the expectations of young entrepreneurs, particularly, of what their businesses are valued, is often setting themselves up a little bit for failure. Around there. Often a business has a very limited proof of scientific concept or market concept, etc., is raising money at values that are 2 and 3 times what Horizon was, built on a technology that had 10 years of cooking and real customers. And that expectation often brings investors in who are sector naive, as Neal was saying, and if you get that in and they're coming in on the EIS basis, then you can line yourself up for problems later on. So my advice is ignore the EIS. Should almost be irrelevant. It's just a tax perk on the side. Focus on getting investors who understand your business and understand how you need to grow it, and that there'll be different points of value inflection, etc. So the highest valuation at the beginning doesn't always put you in the best shape.
Darren, Neal, Haran, can I thank you very much. I'm just going to close by reminding people of upcoming BIA events, if I may. This recording will be distributed to you and sent out if you want to share with colleagues, and our next one will be on advances in cell and gene therapy and regenerative medicine on the 14th of September. If you want to see some people face-to-face, these are some events that we've got coming up in the autumn. The Women in Biotech event is on September the 14th. We have a Science and Finance breakfast at the Stevenage Biocatalyst, which is always a good event. And our core event this autumn is the UK Bioscience Forum on October the 20th. I hope to see many of you there, where we'll be able to hear from Simon Stevens, the Chief Executive of the NHS, on the forthcoming Accelerated Access Review and other innovation initiatives with regard to the UK. And our annual Bioprocessing Conference is in Newcastle this year at the end of November. If I can just close by thanking you for listening and thanking our presenters, Darren Disley, Haran Jyoti and Neal Murray. I hope you've enjoyed it, and thanks also to Hannah, who has put this together. So thank you very much, and look forward to seeing you at one of these again. Many thanks.